Welcome to our PolicyCast series. A significant milestone in India's direct tax framework is set to unfold on 1st April 2026 when Income Tax Act 2025 replaces the Income Tax Act 1961. The corresponding rules and forms currently taking shape are likely to be formalized by this date. The transition from the 1961 regime to 2025 regime involves several changes for businesses at an operational level. They need to be ready to adopt and implement them. Let us explore this further as we invite our tax partner Richa Sawhney to share her insights on what taxpayers can look forward to in this transformative year. Welcome to our PolicyCast series, Richa. My first question to you is, what are some of the key transitional aspects that the taxpayers need to take into account during the first year of implementation of this framework? That is the tax year 2026-27. What is it that they should do?
Thanks, Shilpa. The new income tax framework reorganizes and renumbers numerous sections, rules, and forms. Several forms and provisions have also been consolidated, and many thresholds they've been revised. Hence, taxpayers must quickly familiarize themselves with these changes so they are able to easily navigate through these new provisions and comply with the same. It is equally important to understand the repeal and saving clauses, since many provisions from the earlier Act, that is the 1961 Act, will continue to operate in parallel along with the new law. For instance, pending assessments for past years will still be handled under the 1961 regime. Also, proceedings initiated on or after 1st April 2026 in respect of any financial year beginning prior to 1st April 2026 will also be governed by the procedure laid down under the 1961 Act. But proceedings pertaining to tax years commencing on or after 1st April 2026 will be governed by the 2025 Act. Further, at an operational level for businesses, system level adjustments will also be necessary, including updating sections and form references, incorporating the changes due to rationalization of TDS and TCS provisions, incorporating changes in thresholds, and implementing new reporting obligations, for example, related to the SFT filings. Changes may also be required in SOPs, operating manuals, and customer communications. As far as changes in thresholds relating to perquisites and allowances is concerned, compensation structuring for employees may warrant a fresh look.
Well, this is clarificatory, and a lot of planning also needs to be done for smooth implementation of new income tax rules. So it seems not only the taxpayers but even the tax department would need to be ready for this major change. The system level changes, new forms, and the utilities. Will the rules be notified by then?
So, Shilpa, the report of the Standing Committee on Finance, which was presented before the Lok Sabha on 12th March 2026, indicates that a lot of work has already been done at the government level in a phased manner to update the existing system and the e-filing portal. Taxpayers hence can expect a smooth transition. Further, what the report says is that the draft income tax rules, which were made public for stakeholder consultation, are likely to be finalized and notified within the month of March itself. Also, out of the total 190 forms under the new framework, 54 critical ones have been identified, and these time-sensitive forms will be operationalized by 31st of March 2026. The remaining forms are likely to be rolled out in a phased manner during tax year 26-27, depending upon the relevant statutory timelines. For instance, the new ITR forms would be relevant for income of tax year 26-27, so they will be released in due course before the due date of filing of the tax return arrives.
So, what is in store for the individual taxpayer in the tax year 2026-27?
So, Shilpa, with the revision of slab rates under the new regime last year, it was felt that perhaps the old regime would slowly lose its sheen and become redundant, especially since a large number of taxpayers have already switched to the new system. However, the recently announced rules have substantially increased the exemption limits for several allowances and perquisites, What it effectively means is that there is a new lease of life for the old regime. As a result, salaried taxpayers may now need to reevaluate their tax computations to determine which regime now gives them a more favorable outcome. The government perspective, however, continues to be that these changes in thresholds, they represent an effort to align the tax framework with today's economic reality rather than a policy level shift backwards towards the old tax regime. Also, though the updated return forms have not yet been released, the amended rules suggest certain changes in eligibility criteria for ITR 1, which is Sahaj, and ITR 4, that is Sugam. Taxpayers should be mindful of these modifications to ensure that correct form is used when the time of filing of returns for tax year 26-27 arrives.
Certainly, with these changes, the old tax regime has revived again with the revamped exemption limits for allowances and perquisites. Now, what happens to the circulars issued under the Income Tax Act 1961?
So, any circular, direction, instruction, and notification issued under the 1961 Act, if it is not inconsistent with the corresponding provisions of the 2025 Act, it will continue to be in force. So it's not that it is not operational anymore. It would, however, be very useful for the taxpayers if the government issues a master circular, which is a compilation of all the circulars which continue to be operational as on 1st April 2026.
This would surely give a sigh of relief to the taxpayers. Richa, the most talked about change as far as the forms are concerned, please highlight those few changes that the taxpayer should know about.
The forms now have been redesigned as smart forms and aim at improving taxpayers' filing experience. They will be pre-filled to the extent possible with automated reconciliations. So what this will do is it will reduce the time spent on compliances and also do away with the risk of inadvertent errors. But in many cases, though forms have been merged, there are additional disclosure requirements, sign-off requirements which the taxpayers now need to take note of. For instance, in the case of tax audit, while the new Form 26, it consolidates the erstwhile Form 3CA, 3CB and 3CD into a single unified tax audit report, the scope and depth of reporting has expanded significantly. The form has now 53 clauses as against 44 clauses earlier. There is a requirement to report the accounting software use, details of any cloud or third-party data storage arrangements, and server location, including IP address. So this was just one of the instances of additional disclosure requirements. Then if we were to talk about Form 145 and 146, which replaced the old Form 15CA and 15CB, again here more detailed and structured reporting is mandated. Just to take one example, Form 146 now requires a detailed computation of capital gains to be disclosed. Moving on to transfer pricing, the existing Form 3CEB largely operated on representations, whereas the new Form 48, it brings the working papers into the center stage. The focus has now shifted from merely stating which method was applied to demonstrating how the arm's length price was derived through benchmarks, cost build-ups, aggregation logic, and underlying assumptions. Also in the case of foreign tax credit, so when you're availing foreign tax credit over a specified threshold, sign off on the form by the accountant is now required. So in nutshell, what I would say is that taxpayers now need to analyze all these requirements at a much more granular level and make suitable arrangements to comply with them.
That was incredibly insightful, Richa. Thank you so much for highlighting the significant aspects in transitioning from the 1961 regime to 2025 regime. This would certainly help the listeners to understand that with planning few things in advance, operational level challenges could be avoided once the new Income Tax Act comes in place. We will be back again next week with more expert conversations on tax, trade, and policy. Until then, thanks for tuning into PolicyCast.